A market bottom is an environment where fear, despair, and capitulation are the dominant emotions. For the majority of market participants, it represents the point of maximum financial pain and the crystallization of devastating losses. But for the professional speculator who adheres to the methods of Richard D. Wyckoff, a market bottom is not a cause for panic. It is the opportunity of a lifetime. This professional understands that a bottom is not a single point in time, but a prolonged and logical process known as accumulation. This is the phase in the market cycle where the largest and best-informed financial interests, whom we term the composite operator, quietly absorb the supply of stock from a demoralized public. Today, we will conduct a detailed anatomical dissection of this process. We will examine the 5 definitive proofs that signal that informed money is secretly accumulating a position in preparation for a major new uptrend. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't going well. The first definitive proof that a major downtrend is reaching its termination is the evidence of a stopping action. A powerful, sustained downtrend, which may have been in force for many months, does not reverse on a whim. It must first be brought to a halt. This halting process is the result of a powerful force of professional demand finally entering the market to meet the climactic, panic-driven wave of public selling. The evidence of this collision is the first proof that a change of trend is potentially underway. The initial sign that this stopping action has begun is an event known as preliminary support. After a long and punishing decline, a day or a week of trading will suddenly appear that is markedly different in character from what has preceded it. This period will exhibit a significant increase in volume and a considerable widening of the price spread. While the price may continue to fall and even make a new low during this time, the sudden injection of this level of activity is the first tangible evidence that large-scale buying interests are beginning to enter the market. The composite operator, our conceptual model for the large informed interests who conduct market campaigns, is making his first strategic stand. He is not attempting to reverse the trend single-handedly at this point. Rather, he is providing a significant amount of demand to test the intensity and volume of the public's remaining selling pressure. This preliminary support is his initial probe, a clear footprint on the chart that proves that a powerful new buyer has finally emerged to challenge the previously unopposed sellers. This initial gesture is merely the overture to the main event of this phase, the selling climax. This is the culmination of public fear, the point at which the average investor, having endured a long and painful decline, finally reaches his breaking point. His hope is extinguished, and his only remaining desire is to escape the pain by liquidating his holdings at any price. This mass capitulation creates a dramatic and violent event on the price chart. A selling climax is characterized by an exceptionally wide price spread to the downside, occurring on climactic and often the highest volume seen throughout the entire decline. The amateur observer sees this action as the final, terrifying confirmation of the bear market, a sign that the stock is headed for absolute ruin. The professional Wyckoff analyst, however, sees this event in an entirely different light. He sees the irrefutable evidence of a massive transfer of ownership. His analysis focuses on 2 critical data points. First, the climactic volume. He understands that for every share sold in a panic by a member of the public, a share must be bought by someone else. The immense volume is the record of this great exchange. Second, and most decisively, he analyzes the close of the price bar. A true selling climax bar will almost invariably close significantly up from its absolute low. The price may have plunged to a new low in a moment of extreme panic, but by the end of the session, a powerful wave of buying has pushed the price well off its worst levels. This is the definitive proof. It is the evidence that the enormous supply offered by the capitulating public was met and completely absorbed by an even greater and previously invisible professional demand. The selling climax marks the successful termination of the prior downtrend and the end of what Wyckoffan analysis terms Phase A of accumulation. It is the first definitive proof that the stock is now in the hands of strong informed interests. The second definitive proof that a market bottom is in formation is the evidence that the market is now building the cause for the next advance. After the violence of the selling climax has successfully arrested the downtrend, the market enters a new and prolonged phase of price action. It transitions from a state of clear trend into a state of equilibrium, forming a trading range. This is Phase B of the accumulation process. It is during this phase that the composite operator performs the bulk of his work. His objective is now to purchase the maximum possible amount of the remaining floating supply of the stock, and to do so at the lowest possible average price without attracting undue attention that could cause a premature rally. This quiet, methodical process of buying is the cause that is being built for the future effect of a major uptrend. The tactics of the composite operator during this phase are designed to be deceptive. He knows that there are still many fearful holders of the stock who are eager to sell on any minor rally. Therefore, when the price drifts up towards the upper boundary, or resistance of the trading range, he will often sell small portions of his own holdings. This act of selling serves to cap the rally, keeping the price contained, and creating an appearance of weakness that encourages the remaining public holders to sell their shares. He then uses these moments of weakness to his advantage. As the price drifts back down toward the lower boundary, or support of the trading range, he re-enters the market as a buyer, absorbing the shares being sold by the discouraged public. This cycle of buying on weakness and selling on strength creates the characteristic choppy back-and-forth price action that defines a long trading range. It is an environment engineered to frustrate and bore the average trader, compelling them to finally liquidate their positions. The definitive proof that this process of absorption is proceeding successfully is found in a daily analysis of the price and volume action within the range. The professional analyst is not concerned with the minor fluctuations inside the range. He is focused entirely on the character of the price action as it approaches the key support and resistance levels. The most important evidence is found on the tests of support. Each time the price declines towards the low of the trading range, the analyst must demand to see two things. First, the volume of transactions must be progressively diminishing on each successive decline. A test of the selling climax low on a fraction of the original volume is powerful, conclusive proof that the selling pressure is exhausted. It demonstrates that the available supply of stock for sale at these prices is drying up. Second, the price spreads on these downward moves should become progressively narrower. This shows a lack of downward momentum and proves that the sellers are weak and disorganized. This combination of diminishing volume and narrowing spreads on declines within the trading range is the single most important evidence that the process of accumulation is nearing completion. It is the second definitive proof that the stock is being professionally prepared for a major advance. After the long and often psychologically grueling process of absorbing the available supply within the trading range, the composite operator must, before committing his full resources to a new uptrend, ascertain one final critical piece of information. Is the supply truly exhausted? He must conduct a final, decisive test to ensure that any subsequent rally will not be met by a latent and overwhelming wave of selling that could jeopardize his entire campaign. This brings us to the pivotal event that typically marks the end of the accumulation phase and the immediate prelude to the new bull market. This is the turning point. The third definitive proof in our anatomical study of a market bottom is the successful execution of a final shakeout. This event, which occurs in what Richard Wyckoff termed Phase C, is the culmination of the composite operator's preparatory work. It is his final and often most masterful maneuver designed to mislead any remaining bearish interests and to dislodge the last of the weak hands, those stubborn holders who were not shaken out during the preceding decline and consolidation. The successful completion of this test is the ultimate definitive proof that the selling pressure has been completely purged from the market. This final shakeout is most often seen in the form of a spring, or what is sometimes simply called a shakeout. This is a deliberate price thrust below a well-defined and obvious support level of the trading range. Its strategic purpose is to create a moment of maximum bearish deception. To the uninformed public and the amateur chart reader, this break of support appears to be a clear and unambiguous signal that the prior downtrend is resuming. It is an action designed to trigger two specific and profitable reactions for the composite operator. First, it triggers the protective stop-loss orders of any traders who may have correctly identified the accumulation and taken an early long position. Their forced selling adds to the downward pressure. Second, it entices aggressive but misinformed traders to initiate new short positions as they believe they are capitalizing on a legitimate breakdown. The composite operator uses this manufactured climate of fear as his final best opportunity to acquire the last tranche of shares he desires, buying them at the most advantageous prices from those he has successfully frightened out of the market. The definitive proof of a spring or shakeout, however, lies not in the breakdown itself, but in its immediate aftermath. A genuine breakdown, signifying renewed weakness, would attract significant follow-through selling, and the price would continue to decline. A spring, by contrast, fails to attract any meaningful supply. After the price breaks below the support level, the selling pressure evaporates. The true anatomical signature of a successful spring is the character of its recovery. The price will quickly and decisively reverse and rally back up into and through the trading range. A professional analyst must demand to see specific evidence during this recovery. The rally back above the now violated support level should ideally occur on a widening price spread and a notable increase in volume. The widening spread demonstrates a clear and sudden ease of movement to the upside, proving that the sellers are absent. The increasing volume is the footprint of the composite operator's own aggressive buying, as he absorbs the few shares offered below support and then forcefully reclaims the trading range. A successful spring is therefore the final, conclusive test. It is the market's own declaration that the supply is exhausted, and it is the third definitive proof that the path of least resistance has now turned from down to up. With the successful completion of the final test, the composite operator now has the one piece of information that is most critical to him. He knows that the supply is gone. The risk of a new uptrend failing due to a wave of overhead selling has been minimized. He is now, for the first time, free to openly and aggressively commit his capital to the upside, to transition from the quiet, clandestine work of accumulation to the public and powerful work of initiating the new bull market. This brings us to the fourth definitive proof, the show of intent. This is the first overt and unambiguous evidence of the composite operator's bullish intentions, and it marks the beginning of Phase D of the Wyckoffian schematic. This show of intent most often takes the form of a sign of strength. A sign of strength is a powerful, decisive advance that carries the price up and out of the trading range. It is often described with the analogy of a jump across the creek, where the creek is the upper boundary of resistance that has contained all previous rallies within the accumulation range. This action is fundamentally different in character from any of the minor rallies that occurred within the range. Those were often feeble and met with supply. A true sign of strength is an event of power and authority. To qualify as a valid sign of strength, the action must be confirmed by a meticulous analysis of its volume and price spread. This is a critical moment in our masterclass on reading the tape. First, we must analyze the spread. The price bars that constitute a genuine sign of strength must be wide and dynamic, with the closes for each session occurring at or very near the top of the day's range. This specific characteristic demonstrates what Wyckoff called an ease of movement. It is the visual proof that the advance is meeting little to no significant opposition. The buyers are in complete control, and the sellers are either absent or are being easily overwhelmed. Second, we must analyze the volume. This powerful upward result must be accompanied by a powerful and commensurate effort. A true sign of strength must occur on a distinct material and sustained increase in volume. This high volume is the irrefutable evidence that large professional capital is fueling the advance. It is the footprint of the composite operator as he transitions from a passive absorber of stock to an aggressive buyer, willing to pay higher and higher prices to acquire the shares he needs. This is a perfect example of harmony between effort and result. The great effort shown by the high volume is producing a great result, shown by the wide, sustained upward move in price. This harmony is the final proof that demand is now in absolute control of the market. The sign of strength is the composite operator's public declaration that the period of preparation is over and that the markup phase, the great uptrend, has now officially begun. Wyckoff developed this detailed schematic for identifying market turning points by meticulously reading the internal action of the tape. But other market titans use different tools to solve the same critical problem, knowing when to buy at the point of maximum pessimism. Bernard Baruch, for example, relied on his deep understanding of fundamental conditions, buying into industries that were universally hated but fundamentally sound. Nikola Davos used his revolutionary box theory to identify when a stock was breaking out of a long-term base, a method that focused purely on price action. Richard Dennis's trend-following system was designed to catch the very beginning of major new bull markets across all asset classes. To explore these diverse approaches to identifying major market bottoms, we created our new channel, Trading Insights. It explores the strategies and philosophies of these legendary speculators. To get a complete education on how the world's greatest traders find their opportunities, we invite you to subscribe and watch. The link is in the description. The turning point has now been successfully navigated. The long and arduous process of absorbing the available supply has been completed. The market has been subjected to a final decisive test in the form of a shakeout, and the composite operator has, for the first time, openly declared his bullish intentions with a clear and powerful sign of strength. The evidence is now overwhelmingly in favor of a new impending uptrend. However, the work of the professional speculator is not yet complete. He must now transition from a state of patient observation to one of precise execution, and he must wait for the final, conclusive piece of evidence that provides the opportunity to enter a position at the point of absolute minimum risk. This brings us to the fifth and final definitive proof in our anatomical study of a market bottom, the confirmation. This is the event that serves as the professional's final trigger for action. An amateur trader, driven by the powerful emotion of the fear of missing out, will often chase the initial sign of strength. He sees the price surging out of its base and, terrified of being left behind, he will enter the market at a high price, at the very peak of the immediate excitement. This is a fundamental strategic error. The professional understands that this initial surge, while a vital confirmation of strength, is not the optimal point of entry. He knows that after such a powerful exertion, the market will almost always have a natural secondary reaction. He patiently and deliberately waits for this reaction, as it provides the safest and most logical point to initiate his campaign. This final confirmation and ideal point of entry is what Richard Wyckoff termed the last point of support. After the initial powerful advance of the sign of strength, or jump across the creek, the market will experience a minor pullback. This pullback is a natural and healthy part of the process. It serves to shake out any remaining short-term traders and allows the price to test the area it has just overcome. Very often, this pullback will bring the price back down to the level of the former resistance of the trading range. This is a critical juncture. The old ceiling of resistance is now poised to become the new floor of support. The final masterclass in reading the tape is to correctly interpret the volume and spread during this test of the last point of support. For this pullback to qualify as a valid and actionable entry signal, it must exhibit two specific and non-negotiable characteristics. First, the price spreads on the bars that constitute this pullback must be narrow, and the downward progress must be labored. This indicates that the selling pressure is light, disorganized, and lacks any professional force. Second, and most critically, the volume on this pullback must be conspicuously and substantially lower than the volume that accompanied the prior sign of strength. This drying up of the volume is the final irrefutable proof. It is the market's own quiet confession that the available supply of stock is exhausted. The powerful buying during the sign of strength did its job of cleaning out the sellers, and this low-volume test confirms that no significant selling pressure has emerged to challenge the new advance. This harmony of evidence, the price holding at a logical support level, the spreads narrowing, and the volume contracting significantly, is the ultimate confirmation that the path of least resistance is now unequivocally upward. This last point of support is the professional's entry point. Having now dissected the complete five-step anatomy of a market bottom, we must synthesize this knowledge into a coherent, professional plan of action. Understanding this process is not merely an academic exercise in chart reading. It is a blueprint for acting with confidence and precision in an environment that is, for most people, defined by fear and uncertainty. The actions of a professional Wyckoffian analyst are therefore characterized by three distinct disciplines. The first is patience. The professional does not attempt to be a hero by catching the falling knife. He does not buy into the panic of the selling climax, nor does he engage in the frustrating and often pointless guesswork of trading within the uncertain confines of the early accumulation phase. He understands that his job is not to predict the exact bottom, but to identify its successful formation. He therefore has the discipline to wait for weeks or even months if necessary for the entire preparatory process to unfold. The second is identification. The professional is a gatherer of evidence. He does not act on a single signal or a hopeful pattern. He methodically waits for the full logical sequence of the 5 definitive proofs to appear on the chart. He waits for the stopping action. He waits for the evidence of absorption. He waits for the successful completion of the shakeout. He waits for the unambiguous sign of strength, and he waits for the final confirmation at the last point of support. He operates with a checklist, and he does not commit his capital until every single box has been checked. This removes emotion and impulse from his decision-making process. The third and final discipline is the entry. The professional's entry into the market is not a panicked or hopeful act. It is a calm, logical execution based on an overwhelming body of evidence. By waiting for the confirmed strength of the sign of strength and entering at the point of minimum risk at the last point of support, he acts with the highest possible probability of success. His risk is clearly defined and minimized, and his action is based not on a guess about the future, but on a scientific interpretation of the market's own completed actions. He buys with confidence not because he is a born optimist, but because the evidence has become undeniable. This video has given you the what, the 5 definitive proofs of a market bottom. But to act on this knowledge with conviction, especially in a climate of fear, you need to understand the why. Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, is the key to that deep understanding. This book is not a dry technical manual. It is a course in developing professional market judgment. In it, Wyckoff shares his own real-world campaigns and the hard-won principles that taught him how to distinguish a false rally from a true market bottom. You will learn the foundational logic of market operations that allows you to act with confidence when others are paralyzed by fear. If you want to move beyond simply identifying patterns to truly understanding the forces that create them, this book is an indispensable part of your education. It teaches you how to think like a professional. The link is in the description. In our conclusion, we have traced the complete anatomical narrative of a market bottom. We have seen it unfold as a logical 5-step process, from the climactic stopping action that halts the decline, to the long and quiet building of the cause, to the decisive final shakeout, to the powerful show of intent, and finally, to the low-risk confirmation that signals the birth of a new bull. Let us close with this final thought. Market bottoms are built upon a foundation of pessimism, and are bought by professionals who have the knowledge and the courage to act when others are selling in a panic. The principles of scientific speculation, as laid out by Richard Wyckoff, are designed to provide you with that knowledge. By learning to read the anatomy of an accumulation, you are learning to identify the footprints of the composite operator. You learn to act in harmony with the smartest money on Wall Street. You learn to buy not because it feels good or is popular, but because the evidence, when correctly and patiently interpreted, has become irrefutable.